We've mentioned a few times now that financial reporting is not complete without the notes to the financial statements. And FASB sums up the purpose of the notes quite well in their paper Conceptual Framework for Financial Reporting, part of the larger FASB Concept Statement number 8. There they say that the primary purpose of notes to financial statements is to supplement or further explain the information on the face of financial statements by providing financial information relevant to existing and potential investors, lenders, and other creditors for making decisions about providing resources to an entity. And in real-world filings, while the 4 financial statements we've covered are front and center, it's actually the notes that take up the bulk of the reporting. We've looked at PepsiCo's 10K a few times in this series, so in this episode we'll try to be fair and turn to Coca-Cola's 10K to see exactly how the notes are structured in a minute. And while the 4 financial statements take up 5 pages of their 10K, because they choose to split their statement of income and statement of comprehensive income into 2 reports, the notes to the financial statements are 52 pages long. So clearly, they hold significant weight in financial reporting. Now, we won't go into all the detail about how the notes are put together here. We want to stay focused on the fundamentals of reading the financial statements. But there is one key idea we need to touch on, and that's materiality. While US GAAP does require certain disclosures for every company, for the most part, the notes are generally focused on items that are material. And while materiality is a very important concept in accounting and could probably be its own short series altogether, the rough idea is this: information is material if leaving it out or getting it wrong could change the decision of someone relying on the financial statements. If we were to use Brightleaf as an example, they reported $600,000 in revenue in 2026. So if they had an error of, say, $1,000, and their actual revenue was $599,000, that's probably immaterial. Doesn't do much to change any decisions of someone relying on the financials. But if they had an error of $100,000 and their revenue was really only $500,000, that almost certainly is material. That's a big enough difference that it may change a decision of someone relying on the financial statements. So in general, the notes aren't meant to disclose every microscopic detail of how the business runs. That would be untenable. We won't be able to look through Coca-Cola's notes and learn how much they paid for gas in their delivery trucks. Instead, they're focused on things that could genuinely change how you understand the business. So with that, here's item 8 of Coca-Cola's most recent 10K as of recording, where they present their financial statements and supplementary data. And you can see right here in the table of contents for that section what they've included. Here are the 4 primary statements, with the statement of income and statement of comprehensive income separated, and then each of the notes management has included to convey all material information. We won't read through all of them, but let's look at a few interesting ones. To begin, here is Coke's statement of income for the period, and you can see they earned $47,941 million in revenue during the year. Like Pepsi, this company is a bit larger than our Brightleaf Coffee Co. And then if we look at their balance sheet, you'll see they have some long-term debt, split into current and non-current portions just like Brightleaf did. But when looking at these 2 financial statements alone, we leave a lot of questions unanswered. How does Coke earn their revenue? Or even where does Coke earn their revenue? And they have nearly $44 billion in long-term debt. Is it all due in 18 months, 10 years from now, or even further out? How expensive are the payments on that debt? Has Coke been able to command fairly low interest rates, or are they paying a significant amount of interest expense on it? These are good questions, ones we might want to answer before investing in or lending to Coca-Cola. And they're precisely the type of things we should be able to learn in the notes. So let's take a look at those. As you can see, the first note describes the business and provides a summary of significant accounting policies. And this is very typical. Sometimes these items may be in separate notes, and you'll often see a basis of presentation note as well in the first few, though Coca-Cola includes their basis of presentation as a significant accounting policy here within this note 1. But generally speaking, The first 1 to 3 notes to the financial statements will include a description of the business, the basis of presentation, basically that these financial statements are prepared in accordance with US GAAP, and significant accounting policies at the company that are useful to understand as we interpret their financial statements. Then if we scroll to note 3 here, we can see Coke goes into a bit of detail on their operating revenues, and we can try to answer the questions we had. They split their revenue into 2 lines of business: concentrate operations and finished product operations. So the concentrate operation sells beverage bases, which bottling partners then combine with still or sparkling water to create the beverage, while finished product operations sell fully bottled or canned beverages to retailers or wholesalers. And you can see they provide a breakdown of their revenue by those 2 categories, along with a separation between the United States and international. There are a couple of interesting things here. First, Coke earns quite a bit more revenue internationally than in the United States. And second, look at the breakdown in the concentrate versus finished products. In the United States, the revenue from concentrate operations has grown quite slowly over the last 2 years, while finished products has grown quicker. But internationally, it's the exact opposite. Finished product revenue has actually gone down in each of the last 2 years, while concentrate operations has grown significantly. And that's probably good for investors, as they state above that while finished product operations typically have higher net operating revenues, they have a lower gross profit margin than concentrate operations. So that's a lot of information on Coca-Cola's revenue that we would never be able to glean from looking at their statement of income alone. And there is a note on operating segments, note 20, that breaks down their revenue even a bit further. We've added the link to their 10K below this episode if you're interested in that. Look for their note 20 on operating segments. And we can do a similar thing with their long-term debt. Here in note 11, they provide a table for us with details on the amounts that make up the long-term debt figures on their balance sheet. The first thing I notice is that while they have almost $44 billion in long-term debt, we can see in this table below that only around $16 billion of that is due in the next 5 years. And if we look briefly at their statement of cash flows, in 2025 their cash provided by operations was $7.4 billion. So these amounts maturing over the next 5 years seem quite manageable. Another thing we can discern here is the interest on their debt. You can see it broken down by a few different categories. And most of their long-term debt is made up of these US dollar notes at 3.6% interest and euro notes at 2.4% interest. So unsurprisingly, given how large and stable the business is, Coke is able to finance some of their assets with relatively inexpensive debt. That's a nice competitive advantage. So again, we won't go through every note, but this is the type of information the notes are meant to convey. While the financial statements provide the overview and compress a lot of financial information into very readable reports, the notes are where the detail is unpacked. And again, the notes are not optional for financial reporting. When auditors go through and audit financial statements, they sign off on the entire thing, notes very much included. In fact, we can see that in the audit report for Coke here in the 10K, completed by Ernst & Young, they state that they audited the balance sheet along with the related statements of income, comprehensive income, share owner's equity, and statement of cash flows, along with the related notes. And together, they refer to those as the consolidated financial statements. And speaking of consolidated financial statements, that brings our series to a close. We covered each of the primary financial statements and the notes. And hopefully you now feel more confident as you look to create or read financial statements. They convey a lot of important information, but as we learned, they all work together and really just tell a slightly different story about the same business. And when you take them together and understand how they interact with each other, you can uncover the full financial picture at any company. So we hope this was helpful, and as always, if you have any additional questions or comments, please drop them in the forum and we'll help in any way we can.